Hello, this is Professor Close, and today we're going to talk about the financial statements and general ledger. Now, we have looked at two subsidiary ledgers or operating activity areas, accounts payable and accounts receivable. The other big one would be payroll. We also mentioned that we might have a fixed assets ledger, depending on the accounting software that the company uses. That may be integrated with their ERP. But everything rolls up, right? It rolls up to the general ledger, which is considered the official financial record of the company. And we make adjustments to that ledger. Um, Every time we produce a financial statement, we make some manual adjustments, and at the end, we make some closing entries. This leads us to a trial balance. The trial balance leads us to financial statements. So this is a very important area. Um, I talked about many of us might start careers in accounts payable, accounts receivable, payroll. You actually have to be a little uh, bit experienced, but to work in the general ledger, but it is certainly a starting point. Most full charge bookkeepers are competent with the general ledger. Staff accountants, they would be designated in the general ledger. Certainly controllers have to be very adept with the general ledger. So let's take a look. All right. Now, this looks a little bit overwhelming. You know, our chats are kind of previews or reviews to give you what I think are the key points. So I just talked a little bit about what we call the accounting cycle. So the accounting cycle begins with us gathering information, looking at transactions, and deciding whether they should be recorded. Once we decide they should be recorded, they might be recorded in a special ledger, say fixed assets, or recorded in a subsidiary ledger first. This would be AP, AR, payroll. Or it might be recorded into the general journal. Remember, the general journal is something we call the day book. The general journal simply lists transactions by day, date, and time, right? So we called it the day book because it was chronological. Once we post into these different various journals, they come together and are rolled up into the general ledger, which is the official record. So the general ledger categorizes things or arranges things by account. So there's going to be cash, there's going to be AR, there's going to be AP, there's going to be payroll, there's going to be rent expense, right? All those accounts that we see in a company's chart of accounts. When we have posted, right, to the general ledger, every time we produce a financial statement, we need to bring all of our accounts up to date. And typically what we're doing is we're looking at the balances in the balance sheet. We're making adjusting entries that will bring those balances up and will send, so to speak, any credits or debits that need to be on the income statement. So if you remember some of the rules of adjusting entries, I said that one, they will never involve cash on the accrual basis of accounting because the cash has already happened or will happen in the future. We're concerned about recognizing revenue and accruing expenses. So those entries will never involve cash. They will always involve a balance sheet and an income statement account. So that's how we get our balance sheet up to date. Then we run the trial balance. The trial balance looks to see, do we have any really obvious errors, right? And an error could be, and this is where I get back to, you have to remember the normal balances of your accounts, right? So what's the normal balance of AR? AR is a debit balance because it's an asset. Would I want to see a ending credit balance in AR? No, right? Same kind of concept. I want to go in then and say, oh, I need to look at that. Same kind of concept in AP. The normal balance of AP, it's a liability, so it's a credit. If I end up with the ending balance in the debit column of the trial balance, right, then I need to say, okay, what happened here? So the trial balance is a way of giving us red flags, right? At AP, if we have a debit balance, could we have paid something twice, right? So our systems are good and they help us mechanize all that rolling up, recording and rolling up and putting out the final numbers. But we still need a trained accountant's eye to understand how the system should be working and what we need to do. If we see some anomalies in the trial balance, we make more adjusting entries. Then we prepare the financial statements. So this is what we call the accounting cycle. The last thing we're going to do is post closing entries. Remember, the balance sheet is forever, right? It's a snapshot in time, but these accounts continue to accumulate, right? They are the history of the company. When I talk about retained earnings, I say this is the history of revenue less expenses, less dividends over the entire history of the company. If you look at Ford Motor, you're looking at over 100-year record of retained earnings summed up in one account. Every year, though, we want to reset the income statement, put that net profit or loss into retained earnings, and then the balance sheet represents forever. So when we start a new year, we want to see a populated balance sheet, but we want to see an income statement with all zeros in it. So this is part of the closing process. And if you don't remember it, you really should review it because these steps, we really have to go on and see, analyze the red flags. So the biggest risk to financial statements if they're under GAAP, if they fail to comply with GAAP, right? There can be fines, there can be court trials, right? We often hear of companies being fined by the SEC for misstatements. Who ensures that we're covering GAAP? That policies and accounting procedures are known to everyone in the organization, right? Helps the company follow documents, makes sure things are implemented in a timely manner, makes sure the books are closed, makes sure that these red flags are addressed. That's typically a controller. And so control is about monitoring and adjusting, right? Planning, monitoring, and adjusting. Our systems will put a lot of this in. The trial balance, right? That's all about how did these go in there? The system will then show us through a trial balance if our debits and credits aren't equal, right? Or if they don't net to zero. But really, it is the controller who's going to be going through this. When we deal with the accounting cycle, that's in the controller area. When we deal with how to monitor, how to secure money, how to borrow, how special payment areas and things like that, it's going to be the treasurer. That's going to be the finance side of the house. The controller and the treasurer usually report to the CFO or chief financial officer. And, they are ultimately, they need to ensure legal compliance, right? And if we think back, we remember Sarbanes-Oxley before those frauds and the implementation or the release of Sarbanes-Oxley, administrator or high-level executives in those roles couldn't be prosecuted, right? They couldn't be criminally prosecuted. Since Sarbanes-Oxley, they can, right? So that's why we saw the CEOs of some of these major corporations go to jail. So because in the end, if you remember, if we think about audits and annual reports, management is responsible for the content of the financial statements. The auditors or the accountant, the CPAs, they may have some responsibility if they didn't conduct themselves well, but really it's management owns these statements. So all through the general ledger process, it's another area where control is so important. So, and when I've talked to control in the past, I keep going back to this segregation of duties thing, but it's also how we set up our accounting information systems, right? We talked about ERPs in the past, and one of the big things about accounting systems and ERPs is the role that automated controls and what we call roles play, right? So typically, access to the general ledger is very restricted within organizations. It's going to be the controller and then maybe the CFO that can actually go in and make direct adjustments to the general ledger. So this is a point that we don't always distinguish when we first study accounting, but like if we look at AR or AP, right? In say a customer was charged incorrectly. We don't go right to the general ledger and make an entry to sales and to AR. We have to go through the back AR process again, back into the process. We have to reverse the sale and then record the sale correctly through the subsidiary ledger. And the subsidiary, that correction then will roll up and correct the general ledger. The only time we're actually making direct entries into the general ledger usually has to do with things like depreciation, adjusting entries, right? Depreciation, prepaid expenses, um, any kind of accruals that we need to record, all with adjusting entries. And that's going to be done at a very senior level, a general ledger clerk who reports directly to the controller. So otherwise, everything should be done through the subsidiaries. If it's a situation where we have a journal sitting under a control account, right? So I said AR, AP, payroll. If you have a fixed asset module, you should always be going through those to allow the automated entries and only the adjusting entries. And even to that extent, if we know our adjusting entries are routine, we may set up reoccurring adjusting entries that will post on certain dates to the general ledger. But the access through proper IT controls and proper delegation of authority, general ledger is very restricted. One of the risks also mentioned in this chapter really deals with when you have related parties, right? When you have maybe consolidated financial statements and things like that. Because here, the systems themselves may exchange information, but it's really going to be the role of the CFO or the controllers to coordinate the activities and make sure everything comes together in consolidated financial statements and the accuracy. So we often talk about AI, artificial intelligence, replacing accountants. At this point in time, and I deal with AI every day, it may be in the routine things that we do in the subsidiary ledgers, but accountants will always be needed for a higher level of expertise. And that's really their ability to look at the big picture, to analyze things, to see connections, right? And to make sure that we are complying with policies that we're complying with we're complying with industry standards and meeting the requirements that we need to meet. So I don't think there is an immediate threat. It's AI will be a wonderful tool for accountants to use. So the last thing the chapter talks about is what we call XBRL. Now, I can remember it's probably 20 years ago now when we started to implement this. And really, I'm going to simplify it and say this is all about communicating financial results digitally or over the internet. So it really had to do with the type of instructions that had to sit behind financial statements to make them display on the internet, to make them more accessible, to make them downloadable. So there's a whole language that does that. And that's really what this was about. In the beginning, it was going to be accountants need to know how to do this kind of coding and that, right? But at this point, either specialized software does it or specialized firms do it. So it's not too much to worry about, but it's something that a terminology you should know. And certainly there's going to be, for any time we touch our numbers in our financial accounting, we are going to have to worry about control, right? Who has access? Who is doing this? Who has permissions? What is their skill level? How can we put in any automated controls? And then when we need people in the process, what is the process? How do we document it? And how do we have everyone in the organization follow it? So I think this kind of highlights this area and some of the risks, but also some of the power, really, of what our information systems do for us now. Because this whole closing, I like to tell you stories, right? Closing used to take sometimes 3 months. Posting, transactions, sometimes adjusting entries. We had to block everybody from the accounting system while it took hours for the software to post these things and show up in the general ledger. And now we are close, very, very close to real time. But I may have mentioned in some of our discussions, there are still some things, gaps in softwares that they just can't fill in the information um, without the help of a qualified accountant and an experienced accountant. All right, I will see you next time.